Today's topic's a little theoretical, but I think it's important to understand. You might never see this again the rest of your life if you're not a finance major. So we'll look at it. I do ask this on the exam as an essay question. It's about the only essay question on the exam. I used to ask about beta on the exam, but you're hitting that pretty well on application number 8. So I'm gonna just stick with that. So I like this question, even though it's theoretical, because it helps you really understand, see if you really understand some of the basics of finance. So it's this question: is there an optimal capital structure? Is there a way a firm can put it together? How much it uses in debt, how much it uses in equity, stocks versus bonds, debt versus stocks. Is there some optimal? And the optimal answer, and this is really important, there's certain things you have to have on your answer on the final. I'll show you what they are. But one of those is the maximum value of the firm is at the minimum cost of capital. You can minimize your cost of capital, you're going to get the highest value for the firm. So that's what we're looking for. Is there a way we can structure this firm between debt and equity? And on the surface, it looks like there is. Because we know the cost of debt is the risk-free rate plus a spread. Anybody remember the cost of equity? Risk-free plus what? Market risk premium times beta, right? The most famous formula in all of finance. And what we know for sure is KD is always going to be less than, I've heard some debates on this, but KD always is less than KD. So cost of equity is always greater than cost of debt. Why? Well, because if the firm goes under, the stockholders are wiped out and the bondholders get whatever is left. So it's riskier to be a stockholder, so they should have a higher cost of capital. So some people look at that and say, well, if cost of debt is always lower than cost of equity, and there are some debates. I know in 2008, people are arguing that wasn't, but that's the case. That's because the markets there's some problem in the market. There's some disruption, there's some error. So 99.99% of the time in normal times, you're going to get a lower return loaning money to someone than investing in their business. Because if you loan their money, you got collateral. If things go wrong, you get your money back as much as you can. So sorry, I don't know what this noise is. It keeps coming back. So the obvious thing would be increase the weight of debt and WACC should fall, right? That's what you would think. Don't write that down because that's wrong. But that's what you think. You increase your weight of debt, and if KD is less than KE, the answer is no, because, and you did this on application 8, when you went to the debt to equity and you saw a firm had really high debt to equity, what did you do with your beta? You remember? A firm with a lot of debt has what kind of beta? A high beta or a low beta? It goes up. And so that's not true, because as weight of debt increases, beta increases, so KE increases. And so, yeah, you get more weight of debt, that's cheaper, but your cost of equity is going to go up. And if we're not going to do the math, but if you do the math, mathematically, KE increases exactly to offset the weighted D increase. So WACC does not change. I could show you mathematically, but WACC doesn't change. If you increase your weighted debt, that increase in weighted debt increases your beta so much that you end up with the exact same WACC afterwards. Some textbooks actually do the math. You can go find it online. If you're a finance major, you might want to get into that. If you take a corporate finance class, they'll probably walk through that math in that class. This is all before taxes and bankruptcies. So before taxes and bankruptcy, the answer is capital structure does not matter. You cannot increase the value of the firm by shifting between debt and equity. It doesn't matter. Why? Because more debt, yeah, debt's cheaper, but your cost of equity is going to jump up and offset that. You're going to end up in the same place you started. That's the answer. Doesn't matter. Again, before taxes and bankruptcy costs. And this was Miller Modigliani. That was their initial findings. It doesn't matter. Doesn't matter if you borrow money, doesn't matter if you pay dividends or buy back your stock, none of that matters. And the reason they said that, so see how we're bringing all this whack stuff back. The reason they said that is the value of a firm entirely depends on the value of its assets. You're not going to increase the value of the firm by shifting around who owns those assets. The value of the firm is the value of those assets. It's the present value of the cash flows from those assets. And probably the best way to think about this, let's say you buy a house, you buy a $500,000 house. What happens to the value of that house if you put 20% down or if you put 40% down? What happens to the value of the house? It doesn't matter, right? And that's what they're saying. The value of the house is based on what? The value of the house, what you can sell it for. Whether you put 20% down or 40% down doesn't change the value of the house. It changes your equity, your value, but it doesn't change the value of the house. And that's what they're saying. And this is a quote from, I don't know which one of them, might have been both of them. Simply reshuffling paper claims on the cash flows from the assets does not add or subtract value of the firm's assets and doesn't affect the firm's value. Its stock price doesn't have any impact at all before taxes and before bankruptcy. Right? Now, how many of y'all live in a world where there's no taxes? None of us, right? You're going to be paying some income taxes, don't you think? You're all going to be very wealthy people. I don't know who the poorest student in this class will be, but it'll probably be someone making 6 digits in 5 to 10 years from now, pretty easily, I would think, right? I don't know. Maybe one of y'all will say, "I give up. I'm going to go live on the land, some trailer somewhere. I can't take the stress anymore." Maybe, but probably most, if not all of you, are going to be very wealthy people paying a lot of taxes. Taxes are going to be a big part of your life, especially again, given that my generation has completely destroyed the entire economy with $30 trillion worth of debt. So y'all got to pay for all of our mistakes. Plus, my generation, as much as a mess we've made, we're going to make sure you keep paying us Social Security because we're going to vote. So, you know, you got a disaster, you're paying a lot of tax. That's probably true for corporations as well. Even though I'm in the camp that doesn't think corporations be taxed, I think it should all be passed on to their owners. That would actually increase taxes on the wealthy if you did that. But more than likely, I will not win that debate. We will keep paying corporate taxes. Some of you are accounting majors that want to do corporate tax, so you're hoping we keep taxing corporations. Taxes is a big part of it. It probably will be going up. We haven't seen, Biden hasn't reversed Trump's tax law yet, has he? He's had a tough time doing that. What's the chances he's going to be able to do that after November? Probably going to get lower. So it looks like corporate tax rates won't be going up here soon, but probably over time, there's a good chance they could. The U.S. still has, I think, I haven't looked at it recently, but I think we still have a higher corporate income tax rate than a lot of other countries. We may not be as low as Ireland or somewhere, but it's still, I think Trump, one of his arguments was reducing corporate taxes, that we did have a much higher rate than other countries at 40%. That was a pretty high rate. So if corporations pay tax, interest expense is tax deductible. So if interest expense is tax deductible, what corporations are saying is, hey, if we borrow money, a portion of our cost of capital is going to be paid for by the U.S. taxpayer because we get a tax deduction for interest expense. So you're going to have to work that into your answer as well. Your answer is going to have to be this: without taxes and with taxes answer. So you do need to talk about this before taxes. It doesn't matter. But bringing taxes in, you have something called the interest tax shield. I definitely want those 3 words in your answer. When you borrow money, part of your cost of debt is going to be covered by the U.S. taxpayer because you're going to pay less. Dividends, when a company pays dividends, that's not tax deductible. interest expense is tax deductible. But the Trump tax plan actually changed that a little bit. He made it less tax deductible, but not much, but a little bit less tax deductible. And in fact, when Trump cut the corporate tax rate, he went from like 40 to 21 or something. It was a pretty radical shift. He actually made the value of debt less valuable because less of that cost was being paid for by the U.S. tax code, because it was, the U.S. tax code came down. But still, interest expense still does have a shield. So if the tax rate's 21%, then 21% of your cost of debt is going to be paid for by the taxpayers and not by your corporation. So that's called the interest tax shield of debt. And it's really simple. The value of a firm that has debt is equal to the value of that firm without debt, plus their tax rate times the amount of debt they have. So there's a firm here in town. They got bought out by Medtronic, but there's a firm here in town that we go around bragging about not having any debt at all. And when they brag about that to a finance person, the finance person's saying, hey, you're destroying the value of the firm. If you borrow $100 million and your tax rate's 20%, then 20% of 100 million is 20 million. The second you borrow $100 million, the value of your firm will go up $20 million just overnight. That's what this theory says. It's really simple. If Google were to borrow an extra $1 billion, the value of Google would go up by $1 billion times their tax rate. Pretty simple. Well, that then argues that we should increase the weighted debt to what? To like 99.9999999%. Let's just load up on it so we get that tax shield, where there's a problem with that. And what is that problem? Bankruptcy. You borrow too much money, your firm's always on the verge of bankruptcy because you can't make your debt payments because your income falls just a little bit. You won't be able to afford to pay your debts, and you go on bankruptcy. So you don't want to go so far into debt that you're in financial distress. What does financial distress cause? Are any of y'all applying to Sears for your career? Anyone in here? Anyone applying to JCPenney for your career? Why aren't you applying to those two firms? They're in a lot of trouble. I had an EMBA student who worked for Sears. Like, really? He said, yeah, I'm applying. Okay. JCPenney, yeah, it's a dangerous firm. It probably won't exist in 5 years from now. Maybe someone will buy them out. Maybe
it was already bought out. It was bought out by an equity firm to keep them alive.
Oh, keep them alive, yeah, but it's pretty bad shape. Sears, Sears was, Kmart was the thing when I was a kid. Kmart was the largest retailer in the world, if y'all can believe that. We all went to Kmart. We loved Kmart's. And then Sears bought Kmart, which to me was just phenomenal. I couldn't believe that. And Sears is the largest retailer in the world. And now the two of them together it's almost nothing. It's just a itty bitty. What is Sears? Boy, it really is shocking to me what these firms, how far they've fallen. So Sears is now worth, boy, I won't tell you if I could buy Sears. I could essentially take over Sears. My net worth is, so they're not worth very much money. Why isn't Elon Musk buying Sears? He could do that with his pocket change. It's just not much left of this firm. I think the M means millions. I don't think it's supposed to mean thousands. I don't think they're worth $7,000. But it's a penny stock, right? 6 cent stock. What's a penny stock? It's a firm that's essentially bankrupt, but we haven't acknowledged it yet. But you're not applying to those firms because there's a good chance they're going under. So that's a big part of financial distress. You lose your best employees. The employees that stay back are all stressed out. It's a terrible place to work. No one wants to be in a firm in financial distress. You lose your best managers, your best executives. It's a snowball effect. You don't want to go that far in debt that people start talking about, they're worried about this firm going under. And where is that point? Well, that's you got to figure that out. It might be when you're downgraded to say like single B or triple C or something that's just, you know, dangerous, low rating. So the direct costs are, you got to file for bankruptcy, you got lawyers fees, consulting fees. The indirect costs are your cost of debt's going to rise quite dramatically. You're going to miss opportunities. You can't buy another firm or add new stores, those kind of things. I doubt Sears has built a new store. Have any of y'all ever been in a Sears? I mean, I don't mean just to walk through it to go to the mall, but have you actually bought something in a Sears? Have you really? Has it been a few years or is it recently? I was tempted to go to Sears just out of nostalgia. As you walk in there, they have the really extremely overly bright fluorescent lights. So it's really uninviting when you walk in there. I don't know how they can figure that out. I don't know what I would buy there, but it used to be people said you just buy the hardware stuff, you know, the lawnmowers and those kind of things, but I don't think even now. So yeah, it's their cost of debt is going to be extremely high. It's probably 18-19% cost of debt, which in itself is going to make it more difficult for them to come back because they're having to pay so much of their debt. They're not going to be building new stores, and then they're going to have restrictions placed on them. People are going to come in and say, hey, you can't pay dividends. Vendors are going to say, hey, we're not going to sign any kind of contract with you to deliver stuff to you. So, you know, we want our money up front, those kind of things. It's going to make, between the debt holders, your not ability to expand your business, from your vendors, your employees, you're going to have so many restrictions. It's just going to make it almost impossible for the firm to survive. I don't think JCPenney's quite there yet, but they're moving that direction. They can move fast. You looked at Blockbuster, that was an incredibly profitable, very successful firm one day, and then a couple years later, it was, what happened? How did Netflix do that to us so fast? It was. I don't remember. Yeah, they might. You hear those stories. I've heard those stories about some other firms as well. What firm was I? I was here to buy. Well, it might have been on that Business Breakdown podcast. They were talking about that. So it can happen pretty quickly. For Sears, it wasn't that quick. It was pretty obvious. Walmart was taking Sears down, and then when Amazon came along, it was Sears just had no opportunity there. Could Sears have survived? Could they figured it out? Probably so. If they've been thinking in that direction, was it bad management, or they just were in the wrong place at the wrong time, kind of thing? So the theory says to maximize the value of the firm, you want to get that tax shield value as much as you can without moving so far that you start worrying about that financial distress. And where is that point? It's hard to say. Dr. Damodaran, if you watch his online classes, which I highly recommend all you finance majors do, he says you can mathematically precisely calculate this. I don't trust him on that. He's a lot smarter than I am, so he should know. But he uses a very simple formula that you used in paper one. It's the times interest earned. If you remember that ratio, your EBIT over your interest expense. He uses that and the tax shield, and he says he can precisely tell exactly what the weighted debt of a firm should be. I don't know any firm that's actually tried doing that. Most firms, it's a theoretical thing where they know, yeah, we should probably use more debt to get the tax shield, but we don't want to chance it, so we'll stay a little bit on the conservative side. So what you got to do on the exam is I'm going to give you a chart. It's going to be a chart that either the lines are going up or the lines are coming down. It's hard to tell that the lines are coming down here. So if the line is going up, the y-axis is the market value of the firm. If the line is coming down, the y-axis is cost of capital. All right, so have that in your notes because you're going to have to figure. I'm going to give you a chart without it being titled, and you're going to have to mark the chart up. All right, so if you're seeing the lines going up, that's the value of the firm. If you see the line coming down, it's the cost of capital. The x-axis is always the same. The x-axis starts with zero debt and moves as you increase the weighted debt. So the far left side is 100% equity, and the far right side is almost 100% debt. Okay. So it doesn't matter what chart I give you, the x-axis is how much debt versus equity you have, going from zero debt to almost all debt. All right, so let's look at this first one. This first one, as you increase debt, the value of the firm goes up for only one reason. What's the only reason the value of the firm goes up as you increase debt? The tax shield, right? It's not because debt's cheaper, right? Because if debt's cheaper, but you're increasing debt, so your cost of equity going up. So this line going up is representing the value of the tax shield. This blue line here is the value of the tax shield if there was no financial distress. The red line starts coming back down. Why? Because the tax shield is being offset by the higher financial distress. And so at some point you use too much debt and the distress, the bankruptcy costs start causing you problems. So where do you want to be? You want to be at the maximum value of the firm. That's your optimal capital level of capital structure, where the tax shield is at its max, and you're not starting to see the bankruptcy costs shut that off. So the green line is the value of the firm that had no debt. The red is the value of the firm. I mean, the blue is the value of the firm with the tax shield. The red combines the tax shield and the financial distress. And you'll notice in a chart like this, when it goes up, the optimal weight of debt is where you have the maximum value of the firm. That's also where the minimum WACC is. It's just they're not graphing the WACC of the firm. All right, does that graph make sense to you? All right, let me show you another version of the same chart. Here they use the word V for value. VU, what do you think that stands for? Not Virginia University, what is VU? Value of the unlevered firm. And so there's a value of the levered firm. And so they have a straight line for the tax value. The purple is the value of the firm just as the increased tax for the tax shield. They have a purple line which shows the value of the firm. Well, boy, I'm not exactly sure. Yeah, I'm not really sure what that purple line is. So the green is the tax shield. The purple is the tax plus the bankruptcy. So they're kind of combining it. So I'm not real sure what that line is there, but very similar thing. They say the optimal value is here. To me, it looks like it's more there, but they're saying that's the max of it. All right, so let's look at this one. So here, they're doing cost of capital. So the max value of the firm is where the cost of capital is at its minimum. What they're showing you here, I don't think they have it really drawn the scale. They should have done this chart using actual numbers. But here, this top line is the cost of equity. And what they're showing is as you add more debt, your cost of equity goes up. As you add more debt, your cost of debt goes up a little bit, and then it jumps up a bunch at the end. But your cost of capital comes down. Why? Because of that tax shield of debt. But then at some point, your cost of capital goes back up because of that financial distress cost. The problem is, I don't think if you combine this purple and green line, you would actually get this red line. So the purple line to me is not net of tax. So this cost of debt is just the cost of debt, ignoring the tax shield. But those are the ones you can do. You can find other ones out there just by typing optimal capital structure. Look how many come up here. What is it? 237 million. There's Investopedia. They'll probably have one of these charts in it. Let's see. Nope. There's Miller Modigliani, just like you would expect. If you click on the images, I think Wikipedia probably does a better job of it. And they probably will have a graph in here somewhere. Nope, I can't believe they don't have a graph. But they'll definitely have Miller Modigliani in here somewhere. Let's find them. So there they are right there, Miller Modigliani. So this is big theory. So you can also click on images and you'll see a lot of the stuff we were just looking at, probably even the exact same charts, right? So this one, what do you think is the y-axis here? The value of the firm or the WACC? Value of the firm. This one is one we just saw, right? This one has the cost of capital over there. This one, you can tell it's cost of capital. Some of them get a little wild, so some of them add extra charts. I don't know what that one is at all. I don't know what that one is. But very, very famous theory in finance, you have some different charts. What I would really like to see that I'm not seeing in here is someone to do one of these charts where they use actual real life numbers. And you could do that with the firm. What Darren does is he uses time interest earned, and based on time interest earned, he assigns a credit rating. And based on the credit rating, he assigns a cost of debt. So you can see how he does it. What I don't really trust him on this, and he'd have to show me a number. I don't really think you can take the times interest earned and get a real precision on the debt, on the credit quality of the firm. I don't think that number, I actually think debt to EBITDA, like he used on paper one, I think that is a better number to use. I think he could get more accurate assessment, but that's what he does. Firms with really, really high times interest earned have really high ratings and thus really low cost of debt. And so he just shows as you increase your debt, your times interest earned is going to fall and you're going to get downgraded and your cost of debt's going to go up. So he does do it in a very precise way. He may even out there on the internet somewhere have an Excel file that you can use to actually calculate that yourself, because he shares all of his Excel files with them. So that's probably what I should type next is Darren. He probably has something, finding the right financing mix. Let's see if he has an Excel spreadsheet that he shares with us here. Oh, this is an article. There's a chart. That's a little different. He talked about the tax benefits of debt, the effects of taxes. Yeah, this looks like a really good paper right here. I should wait. I'm going to steal this and add it to my classes. So he's got some good stuff in there. Yeah, those that are finance majors, I'd recommend you read his notes. He does a really good job here. A lot of his stuff is graduate school level kind of stuff, so he might go a little bit further off. So here you can see the debt ratio, no debt, 100% of debt. What happens to your cost of equity? It goes up. How is he getting this number? It's a precise formula. It really is. You can actually look it up. Just type unlevered debt beta in a search, and the formula will come up. How is he getting his cost of debt? He's getting his cost of debt. When I heard his lecture, he's doing it based again on that times interest earned. He gets an after-tax cost of debt. He gets his cost of capital. So where does this firm, what's the optimal weight of debt for this firm? I should put this on the exam. What would you recommend the amount of debt for this firm? I'd like 30. Anybody see where you get 30%? What do you get at 30%? Minimum WACC. That's all it is. So he actually does this very precisely. What I like about his class, he does this for Disney and he does it for one other company. I forget the other company, where he shows that Disney doesn't have enough debt and he shows the other firm has too much debt, and he does it very precise. This looks pretty simplistic here. This is simple, the first column. This is actually very simple. If you see the formula, it is actually very, very simple. This is the hardest part. As a firm increases its debt, how will its cost of debt go up? And so that's the toughest part. This is not too difficult here because we know what the marginal tax rate is for a typical corporation. We can just go to the tax code and get that. And combining the two together is pretty easy. You just take 0% times 3.6 plus 100% times 9%, you get 9%. You take 10% times 3.9% plus 90% times 9.5, you'll get that. It's very, very simple. to do as he goes on. So yeah, this is great. Boy, next time I teach this class, you're going to see this chart in the class notes. So this is the way to do it. This makes more sense actually than those charts I showed you. So don't be surprised if you see this on the exam. With one question, what question I'm going to ask you? What would you recommend on what? Their weight of debt. What weight of debt you'd recommend? I recommend a 30% weight of debt. I might ask you, what would you recommend for their weight of equity? What would be your answer then? 70%. That'd be a pretty good question to see if you're really following. How do I get 70%? Because 880 is the smallest number here. That equates to 30% debt. If the debt's 30%, then the equity must be 70%. Yeah, great stuff. Really, really good stuff. You can see it right there. Really stands out. The debt ratio, cost of here he's using cost of capital. He could have done the value of the firm, but he did cost of capital because it's the easier one to graph. Here he shows you, see how he did it? Well, he's still doing this. This is exactly what I said. Interest coverage ratio times interest earned. You did that on paper 1. He says you have a really high ratio. What did we say on paper 1? Y'all remember? Where did we say you're a little worried? Around 2. Y'all remember that? If you're above 10, you're pretty good shape, right? You don't have to worry about it. He's using 8.5 as AAA. At 2, boy, just like we said, isn't it? 2 is when you go to below investment grade. You're thinking I'm stealing all my stuff from him, but it's just pure coincidence. He's probably stealing all his stuff from me. Highly unlikely, but wow, this is really good stuff. I'm really excited I found this. How do I save this? Y'all want me to put this on a blackboard? Ammo Darren, optimal cap structure. We can steal stuff. I count off for plagiarism, but not for myself. That's perfectly fine if I steal from him. All right, you see the concept here. So the firms you're going to work for, I doubt they're actually going to do the calculations Dan Darren is doing, but they're going to be very much aware of this. They are aware that more debt reduces your cost of capital, but does create more risk. And they're going to theoretically have probably some point they're pushing for. Most firms like Disney are probably not at the optimal level because they want to have some flexibility to move to the optimal level if some opportunity comes up. So most firms are probably to the left of that, but the theory is correct. It's just, can you get as precise as Dan Darren is showing his numbers? All right, so that's optimal capital structure. You're only going to see that. Well, here's another one. I think that's the exact one I just showed y'all. Optimal capital structure, cost of equity goes up, cost of debt stays pretty flat for a while, and then it starts jumping up. But then your cost of capital comes down because of the tax shield, and then goes up because of the distress cost. All right, so what's going to be in your answer on the exam? I give you a couple of ways to do it. You'll have to read through this and put it into your own words. So this is the toughest part of the exam, is getting into your own words. So part of it is the value of the firm is the value of its assets. So the value of the firm shouldn't change just by shifting between debt and equity, but that's assuming no taxes, no bankruptcy costs. This is the Miller-Modigliani theory. I'd love to see Miller-Modigliani in your answer, because anytime you see optimal capital structure, you'll see their names. Capital structure does not matter to the value of the firm before taxes, before bankruptcies. Why is that? So you need to explain that. Why doesn't it matter? Because as you use more debt, even though debt's cheaper, as you use more debt, your beta increases, your cost of equity increases. Those two exactly offset each other. So your WACC is just a flat line before taxes. However, because interest expense is tax deductible, the value of the firm does go up as you use more debt, because you get the tax shield. You need to get that the words tax shield of debt into your answer. I think I also called it the interest tax shield. Either one of those is fine. Which begs the question, what if Congress made dividends tax deductible? I think you'd be back to their initial proposition that it doesn't matter, because you can get, either way you get the same treatment. So the value of the firm goes up as you add more debt only because of the tax shield of debt. But at some point you go too far and the bankruptcy costs start offsetting that and the value of the firm starts falling again. This you have to have an answer, and any answer on optimal capital structure is the maximum value of the firm is where you balance tax shield and bankruptcy such that, and this is the most important part, the WACC is minimized. The maximum value of the firm is where the WACC is at its minimum value. Okay, very, very important to this answer. And I gave you another list. So I don't know which of these is the better list. I don't know why I have two lists. I think one class said, can you do it again? So I did it again and gave you another list. You could definitely put the formula WACC in there. I won't look for that because you're going to do that in another question anyway. So I'll know that you'll have it. What's missing from this formula? There's one thing missing in this formula. You know, 1 minus the tax rate on the debt. So I left that in here. So that's saying the same thing. So the only reason increasing WD, it reduces your WACC, is because of the tax shield. I think we've said that. Yeah, we've said that. So we've said that. All right. So it's an essay question. The only essay question on the last exam. It's an important one, important and theoretical one. All right. So there's a little bit more to this. That's not part of this answer, but there is more to capital structure than just this optimization. And this is this concept of signals. What management does with debt versus equity is signaling something to the market. Why? Because management has inside information. When management does something, the stock market says, oh, they're telling us something. And so management's preferences are a little wacky, a little out of order. Management prefers to use retained earnings first. Now that's equity. They like retained earnings. Why? Because it avoids all the signals. You just use the money you have already, it avoids signals. When you issue debt or issue equity, you're signaling something to the market. Their second preference is debt. They'd rather use debt than issue stocks. So you got equity first, debt second, and equity third. So it doesn't make sense economically. So it's a signal. Why do they like to do debt? Well, here's what the management thinks. If you issue stock, management's saying, hey, our stock price is really good. It's really high. Let's issue stock and get all this really high. They're not going to issue stock if they think their stock is undervalued. They're only going to issue stock if they think their stock's overvalued. Do you think management wants to tell the stock market, hey, we think our stock's overvalued, so we're issuing stock? Probably not. That's probably the last thing they want to tell the stock market. Even if they believe it, they don't want to do that. So when management issues stock, the stock market's pretty convinced that management thinks their stock is at a good price or even higher. So they prefer retained earnings because it avoids the signals. Then they do debt because they don't want the signaling to the stock market that they think their stock price is at a good level. The other thing about debt is if you issue debt instead of issuing stock, you don't dilute the ownership of the stockholders. And so these are signals. Management has information, the stock market doesn't. So anytime management does anything, stock market says, what are they telling us? What does it mean when management buys their stock back? Well, that's telling the stock market, hey, we think our stock is cheap, we're going to buy it back. Well, that's what management wants the stock market to think. Our stock's cheap, you should be buying our stock. If you're not going to buy it, we're going to buy it back. So that's the opposite signal. We're buying our stock back. So they prefer to buy their stock back than they do to issue new stock. And most of your firms on your paper one, you're seeing firms buying a lot of stock back right now. Issuing debt does have a downside. It creates constraints on management because debt holders, they're not going to loan you money and say, hey, do with it as you will. They're going to put constraints on you. They're going to say, hey, if you get downgraded, you can't pay dividends, or you can't do these kind of things. And why? Because the bondholders, they don't have any upside. If you borrow money from them at 6%, their best case is to make 6%. But if you go out of business, they can lose 100%. So they don't have the upside, so they tend to be really risk averse. Whereas the stockholders have unlimited upside. They want management to take risk. So there's this battle between bondholders and stockholders, and management doesn't like to have to battle with those people, so they're not going to overdo it on the debt. You also have the event risk. What is event risk? Well, right now it's called Elon Musk. Who's having an event risk with Elon Musk right now? Twitter. That's an event risk. Someone comes out of the blue and says, hey, I'm going to buy your firm out. I'm going to load it up with a bunch of debt. That's called event risk. Bondholders hate that because when stockholders do that, they usually try to steal from the bondholders to do that. That's event risk. So I mean, it's interesting what Musk is doing. It's, you know, when you're worth, what is he worth now? 100 and something billion? And he's buying a $40 billion company. Yeah, it's pretty crazy stuff. Can he do it? I was talking to one of my other students. The board and management is setting up all these. We're going to talk about this. You know, these kind of poison pills kind of things. It's pretty dangerous for them to do that. Someone comes in and says your stock's worth $50. I'll pay you $60 for it. And management tries to kill that deal. Well, management can now be sued by their stockholders saying, hey, I wanted the $60. So they're taking personal risks. They can be personally sued. And if Twitter's management tries to destroy the company so Musk won't buy it out, the stockholders aren't going to look kindly on that. So they're taking some risks to do this. If you were a Twitter stockholder, would you want Musk to buy you out at a 20% premium? You know, that's what you have to kind of debate. I've had some investors say they were mad they got bought out at a 20% premium because they thought the stock was worth even more than that. Maybe that's why they're buying the stocks. So that it's interesting. It's an interesting. I think he's actually been getting himself in trouble with the SEC, starting to talk about taking Twitter private. That's kind of interesting if he were to do that. What's even more interesting is all the politics behind this whole thing. I mean, there's so much going on with this entire transaction. So it's just a bizarre. I don't know how many Twitter employees would quit if Musk took over the company. Do you think that would be an issue? Do you think people would just start quitting their jobs? You know, it's kind of interesting. What if Musk bought Google? That'd be really fun, wouldn't it? So these are these things that come out of the blue. They tend to be really negative for bondholders. For bondholders tend to be extremely conservative people. They tend to put a lot of constraints on management. So signaling effects is important. There's other signaling effects. Management owns shares of the stock. So one thing people watch for is the CFO just sold 500,000 shares of the company stock. What is that telling you? Well, that might not be good because the CFO certainly has inside information. And if she just sold 500,000 shares of stock in a company, is she selling because she thinks bad news is about to come? Well, if the last 7 years she sold 500,000 shares every year, probably not an issue. If the last several years she sold 100,000 shares and in this year she's selling 800,000 shares, that's going to be an issue. And there are investment firms that watch just management's transactions. Now, does the CFO have to tell people she's selling 800,000 shares? Absolutely. She's an insider. She's trading. She has to tell. She has to report that. I think it's Form 8, isn't it? SEC. I think it is. SEC Form 8. Boy, it's been. Y'all can tell I've been retired for some time. So following me as percent, I don't think that tells us what that is, but requires companies file to announce significant events relevant to shareholders. I think that's where if an insider does it, insider trading. So yeah, you can't. So that's good for us as stockholders. You would want to know if the CFO suddenly sold a bunch of shares. That'd be pretty important to you. But you also have to look historically because a lot of times people will sell 100,000 shares just as part of their regular cash flow needs. You know, they're buying that $7 million house kind of thing. So dividend policy is very much related to this. And that's what you're doing with your cost benefit analysis. If the firm has projects with positive net present values, they should do those projects and not pay a dividend. It makes more sense. If they can add value by doing projects, why send the money back to your stockholders? They should reinvest it in the firm. So that's the way dividend policy should be. Dividend policy is part of this capital structure. If you pay a dividend, you're reducing your weight of equity because you're sending money back to the stockholders. And that's part of this whole process. So a lot of theory here. I'd be curious when, if you get a good intern this summer, this is another thing you would want to ask about. There's so many things, if y'all get a good intern, I'll send you a list of questions you should ask. Hopefully I don't get you fired, but that's the purpose of an intern. And you should tell your boss that. I know some interns, we had them at USA, we call them hole punchers. Y'all know what a hole puncher intern is? Have y'all heard that term? They just they punch holes and put papers in the big notebooks that no one ever looks at. And that's their job for the summer. That cannot be an internship. If you get in those, you got to run. You sit down with the person and say, I'm an intern because this is a training job. You're paying me very, very little. And part of the reason I'm working for you for so cheap is you're going to let me know about the company. I used to my interns loved it because I would take them to meetings with the CEO of the company and say, you say one word, you're done. You can sit there and listen, but don't say anything. Because I don't know you well enough to say what you might say in a meeting. But yeah, I wouldn't let him go to meet with the CEO, CFO. They could come to our asset strategy committee meetings and hear us all scream. They could talk in that meeting. We're screaming at each other. I can't believe you think the Fed's going to do that. So they got to do those kind of things. I wanted them to see the real life of what's going on. That's the kind of intern you want. But if you get that kind of intern, you should say, hey, I had this really wacky finance professor, and he said I should be asking about these 12 things. How does Valero determine its weighted debt? I'm just curious. And they say, oh, well, Pat does that over in the finance department. Well, can I go talk to Pat? And they say, well, I don't know, Pat's pretty well. Can you call Pat and ask Pat if that's what you got to do. You got to be. Are y'all going to be that aggressive in your interns? You can be scared to death. What's the worst thing they can do to you? Fire you. Is that so bad? That's not the worst thing in the world. They can't torture you. They can't take money back from you. So go for it. This is your intern. Take advantage of it. Ask these kind of questions. All right. The next section we're going to do really, really quickly because if you're not a finance major, it's not that big of a deal. We kind of just talked about it. Then we're talking about Twitter. But business combinations. Two firms getting together. ExxonMobil combining. Massive, massive, massive. Why do firms do that? And they do it for the exact same reason they do everything else. It's to increase the value of the firm. If those two firms together are worth more than they are right now separate, then you do it. Anybody know what that's called? Starts with an S. You're looking for what? What's this word? You may want to use it in your interview. Synergies. Can y'all still use this word? There's some words that are so overused. And when I was at the end of my career, I think I told you these words. Y'all remember space? Stop saying space. I was so sick and tired of hearing the word space. I'm in the small cap space. Like you manage small cap funds. You don't need to say space. Paradigm was a big word. Do y'all use that anymore? So paradigm is a word you can't use anymore. It's just too much. And then for some reason, the word robust came in. And boy, I hated the word robust. Every single meeting I had with outside people, they were using robust. So synergies may be one of those words, but I don't think it is yet. Firms are looking for synergies. What is a synergy? So the two firms have 40 accountants and 40 accountants. They put them together, and what do they have now? They have 50 accountants. What did they just do? They just got rid of 30 accountants. That's synergy. That's called what kind of synergy? An expense synergy. The two firms together have fewer workers. Why? Because you don't need 80 accountants. You only need 50. You may not even need 50. You combine them, you have fewer accountants. What about revenue synergies? Where do you get those? Well, it might be what Citibank tried and really failed. And they said one-stop shopping. So let's buy Travelers. And so our bank customers can buy not just their banking from us, they can also do their investing, they can do their insurance, they can just walk into our lobby and whatever they need, one-stop shopping. Didn't work. Why didn't it work? Because we have the internet. You can get your cheapest auto insurance over here. You can get your best investing over here. You can bank. You don't need to combine those all together. USA is somewhat of the only company that's really gotten that to work really, really well. And that's because their synergy was trust. Their customers trusted them. So they bought it all from USA because they trusted USA for all that kind of stuff. But it hasn't really worked. But there are firms trying that, combining two firms together so that their products complement each other. I know Facebook's doing that by buying all these meta firms and all these VR firms, trying to find the firm that has something they can tap into and make the firm more valuable combined versus separated. There's certainly those. It can be new markets. So you got a firm that has a great product, but they're not in China, so they buy a firm in China and they use that firm to do their product. So Walmart did that by Flipkart. I was bad-mouthing Flipkart for a while, that Walmart really got kind of some bad kind of regulatory pressure. But it looked like Flipkart's actually doing pretty well now. But that was Walmart's way to get into India. Walmart wants to be in India because it's a very large population, a lot of consumers, a growing middle class, but they're having a tough time doing it, so they just bought another firm. So new market, new products to go with existing products. Or I don't know what that would be. We were looking at Clorox. Y'all know what Clorox does? Bleach. And so Clorox bought Hidden Valley. Did those two products go together? Have you ever been to the store and said, I need some bleach? And oh man, I wish I could find some dressing from the same company that sells bleach. Does that make any sense to you? So what's a company that could combine with another company such that they have these products that go well together? I think the firm, I can never remember the name, the bicycle firm, starts with a P, Peloton. So Peloton is trying to combine with a media company because they discovered all this music they're using costs a fortune. So they want to start a music production firm. So they could buy a music production firm, maybe they'll buy Panera or somebody. That makes a lot of sense. That's a big part of their, I don't use their product, but that's a big part of their business. Music's a big part of their software, but they have to pay a fortune every time they use someone's song. Then we'll just hire our own artists or do our own song. So that's the kind of thing you're looking there, kind of revenue synergies. And then pricing power. This is monopolies. How well does that work? I'm going to buy all the competition so that I can raise my prices as high as possible. The guy who bought the AIDS drug, he tried that. How did that go over? Didn't work too well, did it? So I increased the price of the drug from $200 to $20,000. That doesn't hit the press very well when you do that. Governments don't like that, but you try buying up all of your competition. So those are the kind of things you're looking for. There are WAC synergies. Did y'all think about that? You combine the firm in such a way that the cost of capital goes down. I saw this with Valero, when Valero spun off Corner Store. It was kind of the opposite. They didn't buy Cornerstone, but they spun off Corner Store because their opinion was both Valero and Cornerstone had too high of a WAC because the two firms combined were so complicated. The cost of capital was higher. So they thought if we split the two firms, they'll both get a lower cost of capital because it'll be easier for the market to assess them. I think that's true. I think that's true about GE. Y'all know GE? I don't know if y'all buy GE products. You probably do. Doesn't GE still own NBC or not? I don't know. I used to rock, what is it, third? What is that TV show? 30 Rock. Don't they have GE as their owner or whatever? But GE is a very complicated firm. They do everything. They have media, they have insurance, they have high industrial kind of stuff. And there's an argument that GE is so complicated, no one has a clue what their cost of capital should be. It's just too many businesses. And so every time GE spins off a firm, their value goes up because the market is just like, this firm is too complicated. And so that's somewhat the opposite of what I'm saying. It's not combining firms to get a lower WAC, it's splitting up companies to get a lower WAC. But you'll see that with GE and Valero. of thing. So there's different ways to find these synergies. Dr. Demidarin, he has assessed these synergies, and he says most of them fail miserably. He says most of these firms that combine, they end up being less valuable afterwards rather than more valuable. Now his number is like 94% of business combinations end up destroying value. I don't know how he gets that 94%. This is his area of expertise. He studies this quite a bit. He says the most successful ones are the expense synergy ones. Those are the ones where firms, they combine in order to reduce their expenses, but those are also the most politically sensitive ones. I don't know if y'all remember Mitt Romney running for president. Is that before your time? But the Democrats gave him a hard time for working for Bain Capital. What were they saying? What did Bain Capital do? They combined firms together and laid off a bunch of people. And they said, look at Mitt Romney, he's working this firm. They didn't mention the fact that those firms that combined and laid off those people years later had far more employees than they laid off. They actually added more employees. And there actually is firms that are really good at expense synergies actually end up hiring more people and laying off, but that was not positive for them. These other ones don't work as well. And so there's some debate whether business combinations really add value versus just add to the CEO's egos. So it's hard to say whether it really works, but that's what we're trying to do. We're trying to increase the value of the firm. How do you do that? You either increase the firm's free cash flow or you reduce their cost of capital. You got to do one of those two things. So you might buy another firm because they have really bad management. You might buy them because you really like the distribution system or you get some pricing power. Redundancies, what does redundancies mean? That means you're going to lay off people. In the UK, they actually call them redundancies, and it's a bad word. Redundancies isn't a bad word in the US, layoffs is. But in the UK, they say they have redundancies, they mean layoffs. They're going to lay people off. You may hire them because you like their processes. Maybe they have some way of doing things that you want to still work on the whack. Mergers can be conglomerate mergers. Those have almost never worked. There's a famous company out there called Boston Consulting Group. They had something called cows, stars, dogs. Y'all might see this. There it is. So yeah, there it is right there. I sure hope your classes don't cover this because I don't think anyone anywhere believes this anymore. But I heard a student say they had this in a class. Have y'all seen this? Have you? I want to ask you which professor, but no, finance says this is absolutely not true. All right, you can tell on me, Rebecca, on your professor, but maybe he or she wanted to debate me in public, but I'll take them on. But yeah, we in finance, we say this absolutely doesn't work. Now, I ran into a guy from the Boston Consulting Group at UTSA, and I go, you know this star cow dog question mark, do y'all still do that? I said, no, we threw that away years ago. So not even the group, and that's right there on the title, Boston Consulting Group. Not even the Boston Consulting Group believes in this anymore. So I don't know why colleges would still teach it, but their idea is you got to have a little bit of everything. You need a cash cow that's going to give you cash when you need it. You need a star that maybe needs a lot of cash, but it's growing really fast. You got this question mark. It might work, might not work. You got the dogs. You want to trim those down, get rid of them because they're just not working. I'm a dog lover, so I don't know why the dog's the bad one. But anyway, that's the idea. It's this concept that you need management that be doing all these different things. And what finance says is absolutely not. The stockholder can do that. The stockholder can diversify in stars and cows and dogs and question marks. We don't need management to do that. The stock market can do that extremely rapidly themselves without management's help. And I remember in my graduate school, we had this case. It was pretty hilarious. It was my team versus another team. And my CFO, who was my boss's 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 boss, was in that class with me. And the two of us were a team because he said, hey, Ron, you'll be on my team. And guess what I said? Yeah, I'll be on your team. I did not want to be on his team, but I was on his team. And so we took the opposing view. Our view was this firm should not have done this merger. It was the American Can Company, and they were going to buy a universal life insurance company. Exactly here. It was American Can Company. It was a cash cow, and Universal Life was a star. So this cash cow was going to go buy a star. And our argument was, stupid decision, they shouldn't do it. Our argument, we had a huge advantage that I was on the team of the CFO of a life insurance company. We knew Universal Life back and forth. So we had a huge advantage over the other team. But Universal Life is an incredibly complicated product. You got a CEO of the American Can Company. What do you think he understands about life insurance? Would the word clueless maybe come to mind? I'm not saying he's stupid, I'm saying he's clueless. He had no earthly idea what Universal Life was, how it works. It's a very complicated product. My mom had one of those. Her premium went from $250 a month to $1,700 a month in 1 month. I said, Mom, why did you buy that product? She has a son who worked in this industry. She had another son that was an actuary. She never called us to ask about this product. I would have told her never to buy that product. It's a horrible product, very complicated. But they were doing the Boston Consulting Group. What did they just do? They just got out into a field they had no knowledge of. It's going to take them forever to figure it out. They were already in an industry that's pretty complicated. They were just getting out of their area of expertise. Their stockholders could have gone and bought a universal life insurance company, couldn't they? Very easily, if they wanted to have 10% in American Can and 10% in MetLife, they could have done that themselves. What advantage was American Can Company doing for its stockholders? There was no synergies whatsoever. I mean, are you going to go buy cans and then, hey, can I get some universal life with that? Probably not. There's zero synergies. That was entirely a Boston Consulting Group. We got an A because the professor agreed with us on that, so we kind of were lucky on that one. And the other team was arguing that diversification, you need diversification. No, we don't need firms to diversify themselves. Stockholders can do that themselves. Management is not adding any value by diversifying the company. And that's the reason why firms like GE trade at such a discount. Because stockholders, they don't need management to do that. They're not doing them any value. So anyway, so I've gotten myself in trouble. Your professor's Rebecca's probably a PhD, and I don't have a PhD. So you can go get me in trouble, but I'm just saying what finance says, all right? Other areas might come back with some argument for why it does make sense, but what does make more sense are horizontal and vertical mergers. Horizontal mergers is two firms in the same industry. They come together, maybe get more pricing power, maybe expand in other regions. Our vertical mergers, you buy a supplier, you buy a customer. That can make some sense. That's what I was talking about with the bike company. They could buy a production company so they can produce their own music. That makes a lot of sense. I've already forgotten the name of that company. Can you believe it? And then leverage buyouts, that's when management gets together and says, maybe you're Michael Dell, say, I don't like the stock market. I don't like what they're doing to our company. I'm going to get management together. We're going to go borrow a bunch of money. Or we're going to take ourselves private. We're going to do a leverage buyout. We're going to fix the company and then we're going to go public again. Bondholders hate that because it loads the firm up with a lot of debt. So anyway, there's a lot more you can do with this. One thing I would recommend that you do if you're a finance major is just go onto the Bloomberg machine and just type MA, because Bloomberg has a tremendous mergers and acquisitions function. You'll be amazed what they have, and you can dump a lot of it into Excel. And even if you're not a finance major, if you get into a class where you're like, maybe it's a capstone class and you're doing a mergers and acquisition case, don't forget about Bloomberg. You'll be able to find stuff on Bloomberg you'll not be able to find anywhere else. It's really, really, really good website. Okay. So that was quick, just introduction. Now we're going to move to my favorite topic. So we're going to spend the next 7 months on risk management. I love this topic. I teach a class called risk management. It's my favorite class. I don't think it's my student's favorite class, but it's my favorite class. I love it. Right now we're talking about the greatest thinkers in risk management. I'm doing all my favorite people, Taleb and just Kahneman, all of them, just really incredible things going on. We're going to keep it very, very high level. So it's my favorite topic, but we're not going to be able to really delve into it. I'm going to argue risk management is the single most important topic for every business major out there. I'm going to argue that every single one of you is a risk manager. If you're in finance, you're a risk manager. If you're in accounting, you're a risk manager. If you're in cybersecurity, obviously you're in risk management. If you're in management, you're a risk manager. If you're in marketing, everybody is a risk manager. That's your job. I don't know what I left out. If you're an actuary, obviously you're risk management. That's what they do. They price risk. And it's something we keep seeing firms blow up and mess up. So this list keeps getting longer and longer and longer. Barings Bank, the largest and one of the oldest bank in the UK, went insolvent. One guy did it, Nick Leeson. There's a book out there. If you have a friend who's an auditing major or accounting major, wants to go into auditing, I would buy this book for them. So this is the auditor book. You probably didn't know there was a book out there for auditors. This is the auditor book. If an auditor had been doing his job, this bank would have never gone under. So that's a good book for an auditor. And it explains what the auditor did and why he messed up. Orange County, the wealthiest county in the United States. If it had been a country, it would have been one of the wealthiest countries in the world. One guy, Robert Citron brought this entire thing down. Robert Citron brought this entire company down. ValueJet, they did stuff that wasn't related to the core business, caused a headline risk, the whole firm crashed. Long-term capital management, about 3 or 4 people made decisions that almost toppled the entire market. This really could have been what happened in 2008, could have happened in 98, but the Federal Reserve got on top of it pretty quickly and try to quash it before it became a massive issue. But too much quantitative analysis. There's a great book here I do recommend to finance majors called When Genius Failed. Lowenstein has some really good books on finance. Enron, that's a story for accountants again, where the accountants are hiding all the bad stuff so that the stock market doesn't know what's going on. Enron was a very good company. They were doing really good stuff. There was a lot of value there. They didn't go under because it was false smoke and mirrors. There was a lot of substance to the firm, but the smoke and mirrors got so out of hand that the firm just couldn't survive. We were talking about Texaco in my class. How do you handle Texaco? I gave an example of my own experience at USA with really unethical management. And we were really lucky at USA. I won't give you the story, but there was a person who could have become our CEO, and I'm so glad he didn't, because I thought he was just a horrible, would have been a horrible CEO. But what do you do when you have people in management that are, in this case, racist, right? These are a bunch of Texaco getting sued for its employment behavior, being sued because they weren't promoting African Americans, and so they sued. And this guy's going to these meetings of people discussing this problem, and he takes a hidden tape recorder and records the whole things. And I won't tell you the things they were saying, but it was just horrendous. And this guy quits, and he gives the tape to the court that's suing them. And now they have all this evidence. These guys are using racial slurs left and right. What do you do if you work for a firm like that? Are you going to expose these people? You're going to get them fired? I hope so, right? That's what you got to do. Hopefully you're not working with firms like that. But do these people still exist? Are there still racist, sexist people working in U.S. corporations today? Are there CEOs that are still like that? I guarantee you there are. Brings the whole firm down. We're in a place now where one person can be exposed and the whole firm topples. It's pretty amazing. Tylenol, Microsoft got sued for antitrust. Bill Gates didn't handle it very well. He pretty much told them, go kick rocks. That's not a good way to respond to regulators. Tobacco industry got sued. 9/11, they were talking about locking the cabin doors on planes before 9/11. Airlines are like, we can't spend that kind of money. It's too expensive. We got to retrofit all our planes. Global Crossing expanding too fast. And then you get to 2008 and it's like, the whole world just falls apart. Bear Stearns, Lehman Brothers, AIG, or Merrill Lynch, Washington Mutual. There are some great books that you should read on 2008. several of them have come out, just excellent asset books. Why do these things happen? You notice several of them was 1, 2, 3, but several of them were one person. One person brought the entire firm down. One thing I did at USAA, I told USAA I want to start doing derivatives. And they're like, oh, fine. It's like, well, shouldn't you put some controls on me? And they're like, no, that you're Ron, we trust you. It's like, so they gave me the power to they literally gave me the power to topple the entire company. I could have done a trade to bring the entire company down. Should USAA have given one person that kind of power? Absolutely not. I had to put my own constraints on myself. I did that, and then I went and told the CFO what they had done, and it's like, oh yeah, we shouldn't have done it. It's like, yeah, you should. You don't know what bad relationship I just broke up out of last week. I'm just going to bring everything down with me. So we're going to talk about that at the high level, because an interview question might ask, what's the most important thing going on in this field? I think your answer should be a risk management answer. I think risk management should always be, yeah, the most important thing we need to worry about is risk management. How are we going to manage risk? So risk management, my favorite topic. This guy, Glenn Holton, his website is actually pretty good. He switched it around, unfortunately. He used to have a really, really great website and decided to modernize it or something. There he is right there. He does have access to one of his articles. The article I'm quoting from here is, he doesn't have on his website. It's called Enterprise Risk Management. He does have this article. I love this article, but I don't know many people that do like it. I just like it a lot. This is someone who makes money as consulting on risk, and he's got this article on defining risk. And he goes through quite a bit. I mean, even as Hume and Knight, and, you know, some of the famous philosophers out there. He comes down to his very, very last conclusion. This is the guy who does risk management, risk measurement. And his question is, can you measure risk? And his answer is, no, you can't. This is his whole profession. This is how he makes money. He says, you can't measure risk. You can only measure some aspect of perceived risk. Why don't we measure risk we can't perceive, because we're not even thinking about it? So he says, no, you can't measure risk. So what he says is, you know, don't ask if these things measure risk. Ask, you know, it's meaningless to ask if a risk metric captures risk. Instead, ask if it's useful. So we're going to use value at risk in this class, which is probably the most common one out there in finance. He's saying it's meaningless to ask if it actually captures risk, because it doesn't, because we're at a huge issue here of, do we really, really perceive risk correctly? As I talk about, you know, the biggest risk, we're talking about Russia attacking Ukraine. That's a pretty big risk. We also have this guy named President Xi, who says he's going to resolve Taiwan during his tenure. What does that mean? What happens if China attacks Taiwan? Does the world say, oh, no big deal? Or does the whole world come crashing down, World War III? My risk management class says it's going to be World War III. I'm retired, so, you know, I'll just move to Costa Rica. You guys are going to be dealing sometime in your career, probably with the Taiwan. Taiwan is the major producer of semiconductors, which is going into electronic vehicles and everything else. I think it's a huge deal. No one's talking about it because no one really knows what to do about it. But what would the U.S. do if China attacked Taiwan? That is like a country where we have really strong ties to. And that's what makes risk so impossible to measure, because that's something that's never happened before. So all the history we're looking at is pretty useless in that particular scenario. COVID-19 was something we'd never seen before. The numbers we saw out of 2020. I don't think there's anyone at United Airlines saying, hey, what happens if our revenue falls 80% next year? I don't think anyone's sitting thinking about that, and yet that's what happened. In 1 year, 80% drop. How does a firm even survive? And they survived, they're coming back. And now they come out of COVID, and what hits them? Now we got jet fuel prices going through the ceiling. So I bought air tickets to Las Vegas for a former student's marriage wedding. I thought it was pretty expensive air tickets. I was a little bit surprised because Las Vegas, it's usually, Southwest area, you jump over there for a couple $100 or something, even $50 or whatever. But yeah, it was close to $1,000, pretty expensive. So you got to manage these risks. These new things keep hitting. So I had this list from his article, and it's a pretty laughable list, mainly because the numbers were so small. My risk class talks about Orange County. That was a $1.7 billion loss. That was a big deal back then. Merrill Lynch in 2008, they lost 1.7 billion, I think, before breakfast in September one day. I mean, it was just, the numbers are massive today. Barings Bank went under, Dawei Bank went under with just a few people. Sumitomo Bank had one guy trading the entire copper market. These are the things he's talking about. And his question is, why are we seeing these huge risks? So he wrote this back in the 90s, saying, why do we see these huge risks? And what we've seen since then is dwarfs what happened in 1990. So not only are things huge, they're getting much, much bigger. And so what's going on? And so here's the key is a few people can cause a tremendous amount of damage. So we're seeing Putin doing that, his decisions about Russia and Ukraine. But in finance, we're seeing it because we have these new securities that are very, very, very levered. You have one transaction, the one where I was talking about in my risk management class and my investment class, are transactions where the market value is zero when you enter it. If you do a futures contract, we're not going to talk about futures in here, but if you buy a futures contract, it costs you zero. It doesn't cost you anything. And so the accountants are thinking, well, what do we do with that? So I did a swap contract at UTSA. I go to the accountants, I'm going to do a swap contract. The notional is $3 billion. It's like, oh, so it's going to be $3 billion? No, it costs zero. There's no cost. What do you do as an accountant on something that doesn't cost anything? You have to put it on the books or not. You got to do something, but there was no transaction. I didn't wire money to anybody, but we now have this transaction. That thing can move $100 million in a day. Someone's going to do something with that. So, and USA let me do that without any constraints whatsoever. Hey, yeah, Ron, go ahead and do whatever you're going to do. It's like, wait, these are pretty dangerous transactions. Warren Buffett hates these type of securities because he sees how they can blow up a company. You saw AIG go under in 2008 because of just a small department doing these type of transactions. So we've changed the world of finance so a few people can do tremendous amount of damage. Is that a good thing? I loved it. That transaction I did, it saved USA a fortune in 2008. I loved it. In one phone call, I was able to eliminate a massive amount of risk. One 10-minute phone call, I could take care of billions of dollars of risk. That's pretty powerful. Something you couldn't have done in the 70s. So I love that. But at the same time, what if I did it backwards or messed up or didn't do the math correctly? It could have blown up the whole company. So a few people can do a lot of risk. And if there was good oversight, these things could have been prevented. However, the other thing you have in here, one person doing something that's incredibly complex. And what do we know about the senior management of firms? They never want to look stupid. So someone comes, AIG and says, we want to do these complex credit default swap transactions, and management's like, oh yeah, I understand that. Yeah, fine. They probably don't really understand it. Merrill Lynch, before they went under, their CEO, a really smart guy, if you look at his background, he went to his department and says, oh, this subprime stuff, how's that going to affect us? And his department says, don't worry, we got it all hedged. What other checking did he do? None. Did they have it all hedged? No, they were all blowing up. They were trying to get them out of their department before it got too bad. Firm went under. And this is the guy who, if you look at his background, he understood those transactions. He could have figured it out. He just didn't want to spend the time doing it. So one person can create a lot of loss because of this concept of leverage. And it's huge leverage. I'm not talking leverage of 10 to 1. So the transaction I did, it was zero when we bought it. A few years later, that thing was worth 500 and something million dollars. We went from zero to 500 million bucks. You think management was thinking I was exposing them? Fortunately, it went to our favor, but what if it could have gone to our negative? Do Do you think management was expecting something to go from 0 to $500 million in just a couple of years? You know, that's very, very, very levered. And it's not that people are more wicked today. It's just we've given them far more powerful tools. So it's something to think about in all of your firms that you're going to work for. Is there someone in the firm that has this kind of powers to do these kind of transactions, and who's controlling them? So the world is changing. He argues, and I agree with him, that risk management is the single most important critical thing that's going to separate winners from losers. You have firms that look like they're doing perfectly fine, and then a COVID hits or 2008 hits, and they go under really fast. So you can't judge who the winner and losers are during normal times. It's at the extremes when you find that out, and that's when you find out really fast that, oh, I didn't know we were doing that. Like AIG is like, wow, I didn't know we were doing that. But yeah, you were doing that. You approved it. He says the elements. If I were you, I would be thinking about this with whom you work. The elements are culture, procedures, and technologies. So what kind of firm are you going to work with? So I love this quote. Are you going to work with a firm? I would probably work this into an interview question. You know, you're supposed to ask a question about the firm. They want to be curious. So, you know, if I were doing an interview, I remember when I interviewed with USAA, I don't know why they hired me. I was right out of school, and boy, I was so green. I had horrible answers. But the last question they asked me is, what do you think is the most critical issue today? I was getting an accounting job, so they're asking the most critical issue in accounting. I don't know what I said. It was stupid, whatever I said, because I didn't know what I was talking about. And I was a music major. I wanted to talk about music. And I'm taking an accounting job. But today, I'd probably say I think the most important issue is how a firm manages risk. Does it have a culture that allows managing risk? If I see something that I think is an issue, can I raise it? Will management listen to me? Will executive management listening to me? Can I rock the boat? Now that may make them nervous. So if you don't like that, you might ask the question, you know, I was in this class that said it's really risk management. It's all about every employee looking out for the firm, looking at risk, be able to rock the boat. What is your culture here? You know, ask them, throw it back at them. What's your culture here on risk management? If someone sees something that's a problem, can they raise it and have it heard? You know, if they don't like that question, then you probably don't want to work for that firm. You got a firm that's like, hey, no, we just all put our heads down and we just do what we're told. That's not what you want. The other aspect of it is you have individuals making decisions. You don't have groups making decisions. A good risk culture has individuals. Now, I noticed that at USAA when I first started, committees did everything. And you know, the purpose of a committee, there's two reasons for committees: free coffee and avoid work. That's why you have committees. I learned that real early in my career, and boy, it helped me tremendously. I went to every committee meeting prepared. Boy, I got all kinds of projects assigned to me. It was wonderful. The easiest thing I discovered is someone sets up a committee meeting. No one knows what the meeting's about. So I would go find out what's this meeting about, and they would tell me, and I would actually do an agenda for the meeting and for the project. And I'd walk in there and everybody's sitting around, you know, they got their free coffee, so they're happy, and looking around, okay, whom I'm going to dump this work on. And I would say, well, I did an agenda, and they're all like desperate. Yeah, hand that out. And suddenly I had control of this group. It's a wonderful part of your career. Don't go to committee meetings. Don't accept a meeting where you don't know exactly what they're talking about. Ask them questions. Especially in your first couple of years, walk in there over prepared in those meetings. Your career will take off. So I was fortunate at USA was committee run business. Young newbies, people coming right into the business, can take advantage of that. And then Bob Davis came along, and Bob Davis says, I don't care about your committees. I want one person responsible for each thing, and that person will take the nosedive if anything happens. So he was like, individuals will make decisions. A lot of questioning. The other thing Bob Davis did, which I really liked, is every time we were about to make a major decision, he went around the room and called each person by name. And he would say, Barbara, do you have an issue with this? John, do you have an issue with this? And people are ready to vote for something. 5 minutes earlier, suddenly you discover they all had problems. They weren't going to bring it up because they're nervous, but now it's so he allowed that kind of questioning. Admissions of ignorance. Will your boss be willing to say, I don't know, I'm not sure, go research that? Or is your boss want to make sure they're always got the answer to everything? I've had both kinds of bosses. I had one boss, I'm gonna put this on the video, but I had one boss that it had to be his idea or wasn't gonna be done. So I would go into the presentation, he'd make some recommendation. I didn't care if it was important or not. I made it really important. I go, wow, I'm so glad you said that. That really opens me up. You know, it's like, I wanted him to have ownership in it because he had to have that. You have to manage these people, right, for your career. And so I had one, he was one, he had to be the smartest one in the room. So I was like, okay, I'm gonna play that game if I have to. You don't want those kind of firms. You want firms that say, you know, I really don't know. I don't care that you're the new person here. You just said something I haven't heard before. Let's talk about this. You teach me. Yeah, that's the kind of firm you want. Procedures, they can be good or bad. I think the problem with procedures is there's just too many of them. They're just massive, massive, massive. I couldn't keep track of them. My last job at USA, I couldn't. It was a massive book just full of procedures. I couldn't read through all of that. I remember one time I just started the job and they come in and say, you got to sign this. And I go, what is it? They say, we don't know, but you have to sign it. So I can't sign something I haven't looked at it. And they say, well, the procedures say you sign it. So I looked at it. It had nothing to do with my job. I said, why am I signing this? I don't do this. And so I read through it. I found one page that had to do with my job. And so I signed Ronald Sweet for page 3, paragraph 2 only. And I gave it back to them. They took it because I signed it. But I made it real clear. That's the only thing in this packet I know anything about. So I'm not signing for the rest of it. But they were happy. Someone signed something. I said, okay, great. So procedures are important, but they can be so overwhelming. And then technology. Technology is a big part of this. Technology, unfortunately, is a cool thing. And so people love to spend a lot of money on technology just because it's all fancy bells and whistles, but you better know what you're going to use the technology for before you buy it. We bought some great technology at USAA. It was incredibly valuable, saved us probably a couple $2 billion in 2008. Really, really valuable, extremely time consuming, really, really tough to deal with because it's just these computer models, they're pretty tough. But we learned a lot from it, but you got to be careful. If the if the program you're dealing with is so complex, there's a tendency for people to assume because it's so complex, it's got so much built into it, it must be right. And I heard this at a conference. I thought it was pretty cool. He said, it's not garbage in, garbage out. It's garbage in, but gospel out because people just assume it must be good because of how complicated it is. So you gotta watch out for that. There's a firm out there that you may have heard of called BlackRock. Anybody heard of BlackRock? What's BlackRock famous for? The largest investment firm in the world, $10 trillion with a T. BlackRock has a risk management tool that is used everywhere. Everybody uses it. Extremely, just everyone's all over the place is using it. There's people starting to get worried that there's some systemic error in this model that's going to hit something, whether it's oil prices or interest rates or something. We're going to discover that error and the entire world is going to just come crashing down because everybody's using the exact same tool. I thought it was a really sophisticated tool. Then one of our students got a job there and he was telling me about what they're doing. And I was like, wow, I thought it was a lot more sophisticated than that. It's like, no, he told me what his job was. It's like, wow, I'm kind of shocked. Given how many people are using this product, what you're doing to help fix some of the things. So it was just shocking to me, but he's not there anymore. He quit and went to a crypto firm. But yeah, we have these things where we're not really sure what the domino effect is. We found that out in 2008. We didn't realize how much of the world was tied to the US housing market. We're finding out with Ukraine, how much is the world tied to Ukraine? You know, Ukraine produces a lot of wheat. That's a big issue. Obviously, Russia produces a lot of energy. We're discovering that. You know, you discover these things. We kind of knew them anyway. I was showing my other class the derivatives market. We're not going to talk derivatives in here, but the notional amount on derivatives, they don't know how much it is, but their estimate was somewhere between 500 trillion and one whatever could trillion, 1,000 trillion, but we're not sure because it's over the counter. No one really knows what everybody's doing. That's pretty scary stuff because when that stuff blows up, you get 2008. So it's kind of scary. So how do you handle this? This is the typical process. The first thing you got to figure out is why you exist. Why does your organization exist? So I think someone in here has a USAA intern or not? You do? So USAA is real clear on their mission, or they have been. Their military and their families, they're going to provide financial services, the leading provider. It's pretty clear when Bob Davis came in, he refocused USAA on that mission. This is what we're all about. If you went to Valero, what would they say their mission is? Would that be clearly identified? If you went to HEB, so why does this organization exist? You can usually, if you're interviewing, you can usually Google their mission statement, and they'll tell you what their mission statement is. Valero will be the premier manufacturer, distributor, and marketer of quality transportation fuels and petrochemical feedstocks while serving the needs of our employees, community, and stakeholders. Is that clear? Quality transportation fuels. Why do they say transportation fuels? Okay, I don't like them already. I mean, if it's transportation fuels and electronic vehicles are 90% of the vehicles, does that mean Valero's out of business? Or aren't they doing liquefied natural gas and providing electrified? Are they doing that? My guess is they are. Why does it say transportation fuels? So if I were interviewing with Valero, I'd say, okay, your mission statement talks about transportation fuels. Does Valero do things outside of transportation fuels? Are you doing heating for houses and air conditioning for houses through liquefied natural gas? I would be curious. Here's their vision statement. Looks real familiar, doesn't it? It's the same thing over again. Their core values, you'll see that: safety, environment, communities, employees, stakeholders. So those are things that are really important to know on your firm. And then you got to ask the question, do they really believe it? When I was at USA, they didn't. When I started, when Bob Davis came in, they got refocused on that. I don't know where they are now with Wayne. Wayne was kind of a finance guy coming from more the real estate side. You know, how focused are they? But that's something really, really important because that's going to drive risk management. What the firm's all about is going to drive how they manage risk. If you think about AIG went under doing something that had nothing to do with their mission statement. They just had this department that say, want to try something. AIG is a very sophisticated, very powerful, important firm, but they went under because someone wanted to try something completely out of their core values, and the whole firm went under. Once you figure out why you exist, you're going to then start doing some analysis. You know, first, figure out what you should be worried about. Risk identification. We usually call that universal risk. You might ask about your firm's universal risk. I don't know if they will actually provide that. Probably not. They don't really provide that. The USA had a universal risk. It was like 100 things, way too long. And some of it didn't even make sense. They had net worth as one of their risks. It's like, when's the last time your net worth attacked you? Any of y'all worried about your net worth attacking you at night? So net worth is not a risk. Net worth is an exposure. It's the thing you're worried about getting hit by a peril. So you have perils and exposure. A peril is the thing that's going to mess up. So the stock market would be a risk. And what might the stock market do? It might crush USA's net worth. So stock market's the peril. The net worth is the exposure. Something can be both a peril and an exposure. So an employee can be a peril. Some employee can do something dangerous that harms themselves and other employees. So the employee is an exposure. An employee can get injured and they sue the company, but the employee can also be the peril. But that's what you want. And risk identification are those things that can attack the company. It can be interest rates. It could be the stock market. It can be for USA, hurricanes. HEB, it might be global supply chain disruptions. You think they're talking about that right now? Are things you can't buy at HEB right now? there's like two things I can't get at HEB right now, and I don't know why it is, if it has anything to do with China or has anything to do with Russia, but I don't understand why those two things are missing. You noticed it in 2020, didn't you? Try to buy a loaf of bread in 2020. It was a little rough, right? I had this argument with HEB. I was friendly about it, but they wouldn't let me buy but just one thing of eggs. And I was like, yeah, but last time I was here, you didn't have any. So why can't I buy my last time and this time together? Because someone else took mine last time. They didn't. I mean, obviously, the lady at the counter, she's like, yeah, whatever, go talk to management. I don't really care. But yeah, supply chain management, that's a huge part of HEB's risk. Do you think HEB's worried about employees getting injured on the job? Is that a big part of their risk? I would think they would worry about that. So that's the kind of thing you're going to do. USA was obviously worried about hurricanes and earthquakes. The next thing you're going to do is figure out how that peril interacts with your company. Sometimes it's really obvious. The stock market falls. We've got $1 billion in the stock market. Obviously, we're going to lose that kind of money. Sometimes it may not be all that obvious. So you have to kind of think through those type of issues. And then what we're going to do is risk measurement. And risk measurement's all about frequency and severity. Frequency is the probability that something's going to happen. The severity is how much you're going to lose. It's going to happen. So right now, people are talking about, is the U.S. going to go into a recession? Why might we go into a recession? So what's the Fed doing right now? What's your money and banking class talking about right now? The Fed is, are they loosening or tightening? Raising or lowering? Raising, so they're doing what? Are they hawkish or are they dovish? So they're tightening, right? They're tightening the economy. They're raising rates. I mean, there's a great article you should read. Boy, I'm a big believer in this guy. I really recommend this. My favorite economist. He just put out his latest write-up. This guy is so good. It's Hoisington Asset Management. Mr. Hoisington doesn't write this. Lacey Hunt does. Lacey Hunt is his economist. I've met both of them, really sharp people, but Lacey Hunt writes some of the best. I have not read this one yet. It just came out. But he shows in this, even though I haven't read it yet, we were talking about it earlier today, how often the Fed messes up and goes too far and causes a recession. That'd be pretty important to you for your firm if the chance of recession is pretty critical thing to understand. And he has some good data. One thing I think he does better than anything else is he has historical relationships no one else has ever thought about. And he brings it in and you go, wow, that's pretty interesting. He has stuff in his papers that absolutely contradict everything they're teaching you in economics. So you remember the multiplier effect? Anybody remember that? What's the multiplier effect? When did y'all take economics? We have economics majors in here, don't we? Multiplier effect. The government spends $100 million, raises government spending $100 million. What's the multiplier effect? That $100 million might turn into $300 million in economic growth. Hoisington thinks the current multiplier effect is a negative number. The more the government spends, the slower the economy is going to be. And he has data to back it up. It's pretty interesting stuff. Your eco professors won't agree with that at all. So you can see his data. He actually has some pretty powerful data. You've seen that in Japan. Japan has this massive government deficit, and they keep spending and their economy just isn't growing. And so he talks about, you know, it used to be the government spent $100 million and we had great growth. Now they spend $100 million and we don't get anything. Well, those are pretty important concepts, right? Because we have Biden now pushing another, you know, $1 billion or whatever. You have this infrastructure bill and all these kind of things. What is that going to do to the economy? Traditional approach says, well, it's going to have a multiplier effect. So that's a huge peril. The probability of a recession is something you really want to understand. You can certainly get that from the economists using leading economic indicators, LEIs, that y'all talk about those in your money and banking class or economics class. Leading economic indicators, that tells you the probability of a recession, the yield curve, durable good orders, the stock market. Did you know the stock market predicts recessions? The stock market usually falls before a recession. The labor market, especially manufacturing, the construction industry, how many building permits. So what do we know about mortgage rates right now? They're at what? Like a 12-year high? We're talking today, while I was talking to one student, he said, well, it doesn't seem like it's impacting much because people are still buying. I asked, well, is it because people are buying as fast as they can because mortgage rates are going up? So maybe we're going to have this real huge increase in demand and then it's just going to die because people are going to buy fast before rates rise and then they're going to get their house and then it's going to all dry up. Who knows? So those kind of things are looking at. Well, how would you tell? You look at building permits. Building permits tell you how much building is going to go on in 3 years. I mean, 3 months, 4 months, right? Because you have a building permit today, then you have construction. So you see how that's a leading indicator. What did they tell you? I'm always curious what you're doing in your ecos classes. What did they tell you the other two type of indicators? You remember? Are y'all forgetting everything they teach in your eco class, or are they not teaching this stuff? This is really important stuff. Huh? Inflation. Well, inflation is an indicator, but is it a leading one or the other two? I mean, you're right, it is one of the indicators. But what kind of indicator? Inflation is not a leading indicator, but what other kind of indicators are there? One starts with an L. You have leading, lagging. What's a lagging indicator? It happens after. So inflation might be a lagging indicator. And then what's the last one? Coincidental, concurrent. It happens. So I think unemployment is somewhat of a current one. Unemployment tends to go down while in the middle of recession. You can't look at an unemployment to predict a recession because it's too late. So these are ones that predict a recession 6 months out. There's some things that happen right in the middle of the recession. So they tell you are in a recession. And there are some things that are lagging. They tell you just came out of a recession. Okay, so which one's the most important from a risk standpoint? Well, obviously it's going to be the leading indicators. So if I were an undergraduate student, I would have the 11 leading economic indicators memorized. I would know what they are. They say these are the 5 most important ones. It's the Conference Board that does this. So you can go to their site and actually see what those indicators are. If the site works. Unfortunately, the Conference Board is a for-profit organization and they charge a lot of money for every single thing they do. So you're not going to get any of this for free. So here is the LEI. Right now, it's actually doing pretty strong. So the LEI, if you see it go negative, it means that's bad, but it's not negative right now. It's actually rising. It's not, this isn't the LEI. What the LEI really is a change in this blue line. If you see that line decline, that's when you start getting nervous. So did you notice this line decline? Here's the recession. When did it start declining? Was it during the recession or after the recession or before the recession? Right here. So the LEI is telling you recession's coming. How good of a job did it do? It did really, really well, didn't it? How good of a job it do here? It didn't do a very good job here. It did start declining, but why didn't it do a good job here? Because COVID just came out of the blue. You know, everything looked really, really good and then COVID hits. So sometimes it works, sometimes it doesn't. Here it worked pretty well, didn't it? The 2001 recession, it was declining, probably a good 6 months out. So pretty important stuff. All right, every business student should be really good on the leading economic indicators. You can do the lagging. And that'll be in here as well. So yeah, this is the kind of stuff I would definitely be learning. Really, really important stuff. Yeah, just go on their site, Conference Board, conferenceboard.org. It says .org, but they charge a lot of money for what they do. So, all right. So frequency, what's the probability we're going to have a recession? And where can you find that data? And then severity. The leading economic indicators don't tell you how bad the recession is going to be. It just tells you you're going to have a recession. So then you're going to ask, well, how bad could it be? You might look at previous recessions and see how bad they were. The 2008 was obviously a really, really bad recession. The 2020 was a really horrendous recession, but it was real short. It hit and then it went away. So it was pretty unusual. The 2008 one hit, it was pretty bad, and it lasted quite a long time. The interesting thing in previous recessions is looking at employment. How long does it take employment to recover? And you can get that kind of data and look. There's all kinds of things you can do to become much more astute at these kind of things. But whatever you can get to understand the probability of something happening, and if it happens, how much could you lose? So you drive a car, so you might ask, what's the probability I total my car? You might say that's 0.5%. So you're going to total your car once every 200 days. Well, I don't know what this frequency, maybe this is every year. You're going to total your car once every 200 years, whatever it is, the frequency. So you have a 0.5% chance. I'm talking about every time you go drive. So, you know, you're going to total your car pretty frequently here. Your car is $30,000. So your frequency is 0.5%, your severity is 30,000. And then we have something called the expected loss. And that's just your frequency times your severity. That's $150. That's what your insurance company is going to charge you, plus expenses and profit on top of that. So they're going to look at, they may have to pay you $30,000 you wreck the car, but there's going to be another 99.5% of the people that insure with them that didn't wreck their car. So they can take their premium and they're going to give it to you to cover that $30,000. All right. So if you're buying auto insurance, your insurance company has a frequency and severity. And how do you think they got the frequency? What do you think they're looking at? Does your age matter, do you think? They're saying you're a 22-year-old male driver with a red sports car. What are they saying? You're going to wreck it. They're going to charge you a fortune. You're a 60-year-old married woman. Yeah, never have a wreck. Right? That's what they're thinking. What else are they going to look up? What about your credit score? Are they going to look at that? Does credit score have anything to do with driving? Insurance companies say yes. There's a high correlation between credit scores and driving. Does that seem fair? People with low credit scores have far more accidents than people with high credit scores. Does that seem fair to you that they're going to charge you more because you have a low credit score? But they are. Where you live is going to have an impact. Those kind of things. How many tickets you've had. Severity is pretty easy for them. They're just going to figure out how much it's going to cost them to replace your car. So that one's easier for them. So that's the kind of thing they do. If you have a house on the coast in Texas, what are they going to be looking at? Probability of a hurricane. How much is your cost? It's going to cost to rebuild your house. Those are the kind of things you do. So insurance companies do this all the time. I can't remember if we have an actual. Oh, yeah, Julissa. Yeah, you're X-ray major, right? So this is what you're going to do the rest of your life, which is a really cool job. Math all day long. It's really pretty fun. One thing actuaries are looking at right now is telematics. I don't know if any of y'all tried this, but an insurance company will put software in your car and they'll grade how you drive. Do you do rapid starts? Do you slam on the brakes? Do you change lanes? Do you speed? And that's probably going to be the wave of the future. There's an insurance company out there called Root, and that's what they do. It's all about telematics. They're gonna figure out what kind of driver you are, and they're going to base the premium based on how you do on the telematics. So the world's changing on how we measure frequency and severity. Extremely important. So we're going to spend some time on this, and we're going to do something called value at risk. Then you have mitigation, and there's two types of mitigation. There's the ones that you do yourself, that's called risk control. And then there's the ones you do by hiring someone outside to help you. So risk control, there's three types. Risk avoidance, that's when you get rid of frequency and severity. You just stop doing it. So you got a pool in your backyard and you're worried that some neighborhood kid's going to climb the fence and drown in your pool. How can you get rid of that risk? You fill in the pool with concrete. Now they might climb the fence and stub their toe on the concrete. So that risk is still there, but the risk of them drowning has gotten really, really low. It's zero. No frequency, no severity. You can do risk prevention. That's focused on frequency. That's when you put a really tall fence around your pool. And risk reduction. Okay, the kid's already in the pool, they're drowning. What can you do to reduce the severity? You can learn CPR. Is that going to be very effective? That's only effective if you're at home and you have some kind of alarm system that tells you or whatever, but probably not all that effective. Prevention can be your compliance and procedures. Tylenol is a famous case. Tylenol had their product tampered with. It was killing people. It got tampered with poison. And people thought that's going to be the end of Tylenol. They'll never survive this. But Tylenol put in a public relations blitz where they actually came out better on the other side because people so respected how they handled the issue. That's very different than Perrier, the water company, Perrier. People were complaining that there was glass in their bottles and people were getting injured, and Perrier said, no, that's not a problem. They just missed the whole thing. And then they discovered it was a problem, caused them far more trouble after the fact. Blue Bell ice cream, you remember their thing? They had tampering with their, or they had their product getting some kind of disease. Their first reaction was not all that good. It's kind of like, no, it's not a problem. And then they discovered it was. That's not good, especially for someone like Blue Bell. They have somewhat of a reputation for trust and all that. You need to act quickly. So Tylenol did that extremely well. So there's things you can do to either focus on frequency or severity or both. Once you do everything you can do, you then have to turn to somebody else. So you might say, I've got a risk of premature death. If I die prematurely, all my income my family's relying on is going to go away. How can I do risk control? Where I can exercise, I can eat right, I can stop doing bungee jumping, those kind of things. Try to reduce the probability of a risk. It's hard to reduce the severity of it, right? Not much you can do there, but try to reduce the frequency. You do everything you can do, then what do? You buy life insurance. So that if you die, your family gets some money, right? So you're gonna be doing this yourself personally, your firm's gonna be doing this as well. What can we do internally to reduce the frequency or the severity of this event? Once we do that, whom can we partner with? An insurance company, some kind of contract that we can do. And in fact, when you do a contract, you seem to realize the number one purpose of contracts is to shift risk. So when you sign that apartment lease, one of the main purposes of that apartment lease is to put risk onto you. I actually sued my apartment complex. I hated the contract and I won. It's the only lawsuit I've had and I won. So I'm 1-0. Pretty cool. I sued my apartment. But yeah, their contract was shifting all this risk on top of me. This was absolutely ridiculous. Y'all probably don't even read your lease. I read the whole thing, actually rewrote the whole thing and sent it to them. They didn't take it. It's like, this is ridiculous. They were having me take risk of stuff my neighbor was doing. It's like, I'm not taking risk from my neighbor. I don't even know my neighbor. So our goal here is risk optimization. Our goal is to take those risks that we do really well and we get paid for and avoid those risks that we're not getting compensated for. So figure out what you're good at. You've got to take risks to make money, but you want to take risk in the places where you're really well compensated. That's why I say in your interview, you want to say, I only want to do stuff when I'm paid for taking the risk. If I'm not paid for taking risk, I'm not going to do it. Which means I got to understand the risk. I got to understand the payoff. I got to make sure the return I'm going to get is going to compensate me for that. I take this entire risk process and I put it in 3 words: define, measure, mitigate. About 50% of my risk management class is define, measure, mitigate. We handle essentially most of these risks: interest rate risk, liquidity risk, price risk, credit risk, operational risk. So my risk management class, we cover all of these. In this class, we're really only going to cover one, and that's market risk. But these others are all really, really important risk. Operational is probably maybe the most important one, but it's the most difficult one to deal with. So let's talk price risk. We may have to skip the others just because of time. So price risk is pretty easy. Market risk is pretty easy. The price of an asset falls or the price of a liability rises so that you lose net worth. So maybe you have a $100,000 portfolio and you're in the stock market and the stock market falls 20%. That's price risk. How do you measure it? Well, you've had some of these. So hopefully you remember the formula for standard deviation. If you don't, go learn it. You need to know that formula off the top of your head. Anybody remember it? Okay, give me standard deviation off the top of your head. You know, can you do it? X of I, what's next? Minus X bar. Does that sound familiar? Xi minus X bar. And then what do? You square it. I remember that. What's Xi minus X bar? I've got 50 months of stock returns. I take the average of all of those. What is that? That's X bar. And then I go get January 2018. That's what? That's one of my XIs. I take that XI, maybe the market was up 2%. Maybe my average is 0.4%. I take that 2% minus 0.4. I didn't square it. What happens when you square it? What happens to all those negative numbers? They disappear. So risk in finance is not losing money. Risk in finance is how far can you get from what you expect, right? That's maybe the most important thing I've said the entire semester. How do we measure risk in finance? How far can you get from the expected value? What's another term for the expected value? It's the average. We tend to think the average is the expected. Is that the right way to measure risk? I don't know. That's the way we do it. What else do we do with this? We take that average square difference. Is this coming back to y'all? Then we got one last thing to do. What's the last thing we do? Take the square root of that. Did I get it right? Does that look right? So there's like 90% of finances in that one formula. That's how finance people think. How far can you get from your expected value? If you can't get very far from your expected value, you don't have much risk. If you're expecting 5%, but your worst case is you'll make 3%, that's not very risky. If you're expecting 5% and you could lose 40%, that's pretty risky. But we look at it over and under. So even if you're expecting 5 and you make 40%, we still say that's risky. Why? Because if you can make 40% when you expect 5, then you could also lose 35% when you expect 5. So we think it's somewhat symmetrical, all right, around that average. So maybe we could be as much as 40% or as low as negative 35%. That's a pretty risky thing, right? So that's it. What about beta? You're calculating beta. Y'all remember beta formula? We covered this earlier in the class. Beta is covariance divided by the standard deviation of the market squared. That's a good ratio, good one to know. Your first start is you do xi minus x bar. So covariance is xi over x bar, but you have to have two things. You have xi minus x bar, or minus xi minus x bar, and yi minus y bar, and you can multiply those two things together. So you see how much of finance is xi minus x bar. It just dominates finance. It also what dominates finance is the normal distribution, because these two formulas rely on a normal distribution. So you have to kind of ask how much of the world is normally distributed. So we're not going to do standard deviation and beta. You're doing beta. You're not actually having to do the formula. You're using the slope formula, right? This is what the slope formula is giving you. We are going to use value at risk. So value at risk is your very, very last number 10, application number 10. We have some others we're going to go back to. Value at risk, essentially what value at risk is it's asking how much could I lose at some probability. And there's three ways to do value at risk. There's parametric. We're going to use parametric value at risk. So remember that term so you can work it into an interview so you sound really sophisticated. So, we did some parametric value at risk analysis. If you're talking to HR, that's as far as you got to go because they won't have a clue what you're talking about. Even if you're an HR degree, you're not going to see value at risk very much at all in your studies. You're going to see a lot in finance. So what does parametric value at risk mean? It just means we're going to use a normal distribution. That's all it means. We're just going to use statistics. Historical value at risk is we're going to look historically and see how often something happens. So if you want to know what's my 1% risk of the stock market, we go back and look at historical stock markets and see 1% of how bad was it 1% of the time. So we go look at that 1% event, and maybe the market was down 25%. We say, hey, our 1% historical value at risk is this percentage loss in the stock market. And stochastic, what's another word for stochastic? You ever heard this term before? Stochastic Monte Carlo. Do y'all do some Monte Carlo in your stats classes? I don't use stochastic Monte Carlo similarly, and Julissa, you might do a stochastic class as part of your career next semester. Yeah, that's probably maybe your most important class. Actuaries are very, very good at doing simulation type of analysis. Why? Because they got to figure out what's the chance of a hurricane, how many people are going to wreck their car. They need to have that kind of analysis to look. I love stochastic. We use it a lot at USAA. To me, it's really, really quite powerful, assuming the model's calibrated correctly. If the model's not calibrated correctly, it's just a bunch of garbage coming out of a really sophisticated looking model. So we're going to focus our attention on parametric. And you can Google it if you like. It's a pretty common term. I don't know if Investopedia has it, but Wikipedia has one. So it's essentially you're using statistics. So you have some distribution. Usually it's a normal distribution. It doesn't have to be the normal distribution. We're going to use a normal distribution. And so it's just a statistical construct. They probably have the others in here. They probably talk about the other ones in here. Let's see. Oops. Need to do that. Well, they don't have historical bar in here, but you can look that one up. I have a really good article that I used to use in my classes where he goes through the 3 types of valued risk, and it's somewhat tongue-in-cheek because he's a little bit negative on VAR, but he does a good job of explaining them. But that's what we're going to be focusing on, is valued risk from parametric. Do firms use this? Yeah, all the time. Pretty common. USAA is a heavy user of stochastic valued risk. USAA has a stochastic model where they put in the addresses of all of their homeowner insurance customers, and then they just start running simulations of hurricanes and earthquakes. And it's pretty amazing what they're doing. It really is. So gotten pretty sophisticated. We're not going to talk duration and convexity in here, although we'll talk a little on duration when we get to bonds next week. And then how do you mitigate risk? So it's define, measure, mitigate. We defined it. We're gonna measure using valued risk. And then how do you mitigate it? The number one way we mitigate risk in finance is diversification. We make sure we don't have all our eggs in one basket. We diversify. How effective is that? Well, read my blog. It's not particularly effective. It's really, really good unless you have a crisis, and then it doesn't work very well at all. And that's true of a lot of risk tools in finances. They work really, really well unless you need them, and then they fall apart entirely. So diversification worked really well until 2008, and then it completely fell apart because everything just crashed in 2008. But we're not going to do any mitigation in here. My risk management class, they actually do quite a bit of that with diversification and that kind of things. Risk budget, essentially what a risk budget says is this is the amount you're allowed to lose. So if your analysis says you can lose more than that, you're going to have to go out and do something to reduce your risk. A risk budget just tells you your limits. So we're going to do measurement, how much you expect to lose. We're going to use valued risk for that. I'm going to give you a risk budget, and you're going to compare your valued risk to your risk budget. If your valued risk is greater than your risk budget, you got a problem, you need to fix it. If your valued risk is less than your risk budget, you're in good shape. You don't have anything to worry about. All right, so you're going to see the very last application is probably the easiest one of all. However, it risks you doing the application without thinking about what you're doing, just plugging numbers in, and you don't learn anything. So make sure you step back and think about what you're actually calculating. All right, very, very important. All right, so know these formulas off the top of your head. Standard deviation, beta, correlation, R squared. Know all of those off the top of your head. If you are a finance major, you should also know duration off the top of your head. So there's certain formulas that you just know as a finance major. If you're an accounting major, or every business major should know these formulas here. And then actuarial science, this is the easy stuff for them. They're going to go far more complex than that. All right, I'm not going to go through those formulas there. All right, let's talk about value at risk. Let me give you the formula first because it is very, very simple. What value risk is doing is it's saying, how much could I lose at some probability? And we get the probability in terms of number of standard deviations. So you probably did this in your stats class. This is probably coming back to you. So a 1% event, do you remember a 1% event being a 2.33 standard deviation? Y'all remember that at all? Nobody? I'm not seeing any heads. Anybody remember 2.33? Any accounting majors in here? You're going to be seeing this when you take your auditing classes. So don't forget this. This is really important. So let me show you as a picture. Does this look familiar? Normal distribution. So what we're saying, a 1% event is 1% of the distribution. And so what's to the right of the 1% event? That's 99% of distribution. So how many standard deviations do you need to go so you hit the 1% point? It's 2.33 standard deviations. So if you have the mean, you have the standard deviation, you want to know where 1% is, you take the mean minus 2.33 times the standard deviation, and that'll put you right there at that point. We'll do some examples so you can see it. But you should have had this in stats. So I'm sorry. Y'all telling me y'all have never seen this ever in your entire life? Is that true? No, y'all are scared to shake your head. You don't remember it? Was it in stats class? Yeah, don't forget this. You're going to see this a lot. So you must say I'm a marketing major. You're going to see this in your marketing majors. Marketing uses this a lot. If you're an economics major, you're going to see this a lot. Right? If you're an actuarial science major, you may not see this because you're going to use more sophisticated math, but you're going to understand this backwards and forwards. So I don't know. If you're a management major, maybe you'll get out of it. I don't know. But boy, this is pretty important stuff. A 5% event, that's a 1.64, 1.65 event. Don't interpolate, so I'll see what I mean by that. All right, so here's the process. The first thing you got to do is pick your risk tolerance. What is your risk tolerance? Is it 1%? Is it 5%? Is it 10%? So if I were to do Goldman Sachs, here's their annual report. They're going to make me click on them doing things to do it. So here's their value at risk. What confidence did they use? They use 5%. They call it 95%. But I'm from the insurance world, so we go the other side. They say 95%. I say 5%. So they have a 95% comp. So they have two ways they measure risk. Value at risk. And y'all probably have heard of this, stress testing. Have you heard stress testing? So stress testing is scenarios. What if we have a recession? What if the stock market falls? Value risk is probabilities, it's statistics. So they do those two kind of things. They even give you tables that show you the numbers, if I can find it. So here's their value risk, $91 million. What are they saying? 5% of the days in a year, we expect to lose $91 million or more. That's what it means. Y'all hear that? Makes sense? So 5% of the time, they would expect to lose $91 million or more. That means 95% of the time, they expect to lose no more than 91 million. Now see how that works? 5% of the time, we're going to lose 91 million or more. That or more is really important. 95% of the time, we expect to lose no more than 91 million. Okay. They show you 2020 versus 2021. You see it's about the same. They have this, what they call diversification effect. That's that correlation I was talking about. What they're saying there is 5% of the time, we expect to lose $69 million because interest rates changed. 5% of the time, we expect to lose $31 million or more because of the stock market. 19 million because of currencies. 30 million because of commodities. However, these 5% events will not all happen at the same time. So you're not going to get a 5% event on interest rates happening at the same time as a 5% event on equities. And because of that, $58 million of risk goes away when you combine them into 4 different things, all right? That's that correlation effect. And here they show you their actual daily losses, and they show you that they actually almost never, oh, that's actual VAR, sorry. So do firms do this? Absolutely, they do this. JP Morgan, Goldman Sachs, USAA. USAA does this, they don't call it VAR, they call it probable maximum loss, but it's the same thing. They're doing this on a daily basis. USAA calculates its value at risk on an annual basis. They ask, how much could we lose to hurricanes on an annual basis? That number might be $5 billion. And they'll calculate it. And their risk tolerance, anybody want to guess what their risk tolerance is? It's not 5%. Their risk tolerance is 0.2%. 1 in 100 year, 0.2%. So they have a very, very low risk tolerance. All right, so the first thing you do is pick your risk tolerance. How do you pick it? It's probably going to be related to what credit rating you want. Do you want to be AAA rated, AA rated, single A rated? The higher you want your rating to be, the lower your risk tolerance is going to be. You're going to be really conservative. The second thing you do is you run your VAR. You just plug it into this. So on your exercise, I give you the risk tolerance. All right, you're just giving it. And then all you got to do is you got to plug in numbers in here. So let me show you how you get these numbers, because this is pretty important stuff. So hopefully you saw this in one of your classes. You're going to recognize this table, I think. Get it wrong, say. Is this looking familiar to anybody? I know I'm stressing you guys out, but don't forget everything you learn in college. It is actually valuable information. You probably know it, your brain's just not there right now, but you equal norms test, 0 plus 0. How much of the normal distribution is to the right of the mean? So if I go right to the middle, you got the normal distribution, and I'm right at the mean, and I go 0 standard deviations to the left or the right, how much of the distribution is to the right of that? I know someone knows it, they're scared to say. What am I going to get when I hit enter? What did I get? Does 50% make sense? So you're right in the middle. So 50% is to the right of the mean, 50% is to the left of the mean. What happens if I go 2.33 standard deviations? Yeah. I hate that part of Zoom. I wish I could have been in their meeting when they said, let's make the escape key how you get out of that screen. So what if I go 2.33 standard deviations? What am I going to get there? How much of the distribution is to the right of that? We just said it. Does that look right? 99% is to the right. How much is to the left of it? 1%. So 233 tells you where 90% of distribution is, and on the left of that is 1%. What if I go to 1.64? Now this time you got to get it. What's going to happen when I hit enter here? 0.9 what? 0.95 or close. All right, that's why I say it's between 1.64 and 1.65. So when you take your audit class, those accountants that are auditing, you're going to be doing this. You're going to ask, all right, we got to figure out if this firm has a problem with their accounts payable. We want to make sure, we want to have at least a 5% confidence that there's not a major issue here. And then you're going to run the numbers. So 5% is going to tell you how many errors you expect to find. If you find more errors in that, then you got to reject that null hypothesis and say, yeah, they've got a problem with their accounts payable. If you find fewer errors in that, then you say, hey, it looks like everything's fine. We're going to give them a clean opinion. All right. So you're going to use this in your auditing class. All right. So we can take this, put it all over the place. And what you'll notice is when you get way out there, there's almost no chance of a 5 sigma event. Almost no probability. I mean, it's there, but it's a very, very, oh, I don't want to hit enter. Let me hit escape. Very, very rare. And in fact, when you get out here, a 10 sigma events, Bill Gates gives up. He just says, that's 100%. Okay. There's no 10 event. Now, it was interesting in 2008, the CEO of BlackRock or Goldman, I can't remember which, but he said they were seeing 25 sigma events. What's the probability of a 25 sigma event? You'd have to live 1 trillion to 1 trillion lives to even see it. It could never happen. So was 2008 a 25 sigma event, or was our math wrong? I love the way one guy said, either 2008 was so far out there. I mean, it's like you walk outside, you get struck by lightning while you're falling, a rabid dog bites you. When you hit the ground, a plane part falls on your head, and it starts snowing in San Antonio in August. All these things happen at once. They're all completely unrelated. It just can't happen. So I like what this one speaker said. Well, okay, there could be that 1 trillion to 1 trillion is what happened in 2008, or there could be the 1% chance that all of his math is wrong. I think it's much more likely his math is wrong. All right, so this is the normal table. You should have seen the normal table in some class already. And it just tells you how much of the distribution is to the left or the right, depends on how you're viewing it, of this many standard deviations. So 0 standard deviations, that's the 50% point. As you move further along the curve, more of the distribution is to the left or to the right of that. And so if I tell you their risk tolerance is 1%, you're going to put 2.33 there. If I tell you that their risk tolerance is 5%, you're going to put 1.64 or 1.65 there. What if I tell you that their risk tolerance is 1.7%? So they got a risk tolerance 1.7%. What are you looking for in the table? You notice 1.7% is nowhere in the table. So what are you looking for? 1 minus. So we're looking for 98.3. Do y'all see 98.3 anywhere in there? A 1.7% risk tolerance would be how many standard deviations? 2.13, 2.12, right? So that would be your number. Now on the application, I think I actually have you equal norms SM. I think we do that one. I always get them mixed up. So yeah, if you do minus norm.s.inv and put your risk tolerance, then it will tell you how many standard deviations that is. So it's actually not 2.33, it's actually 2.3263. All right, so there's 2 formulas there. Equal norms dist. There you're talking about the number of standard deviations. So that's going to give you the 99%. Norms with an S. Why is the S in there? It's like a standard. And then if you do equal norm, that whole thing, I can't remember it. Norm.s dist, then you put the probability in there. I don't know why it's telling me no. Too few arguments. Did I used the wrong one. So I don't know what I just typed there, but minus norm.s.inv, you put the probability in there to tell you the number of standard deviations. Okay, so you can go either direction. I can't remember what I do in the video, so you just watch the video. But so you don't actually need this table. All you need to do is figure it out. I think in the video I give you this formula, and you just need to plug the 1% in there. Oh, wait. I should look at my own notes. So there it is right there. So norm.s.inv, open parentheses, risk tolerance will give you that. What I don't have in here is you need to start with the minus sign. Okay, so get that in your notes. And then you compare your value at risk. The value at risk is how much you can lose, you expect to lose, is how much you expect to lose at a probability. Your risk budget is how much you're allowed to lose at some probability. You compare those two. If the VAR is less, you don't have to do anything. You can even take more risk. If your VAR is higher than someone messed up, you're gonna have to reduce risk somewhere, or maybe you say, hey, our model's wrong, we're gonna fix the model. I love this quote on these type of models. All models are wrong, some are useful. You're always a little skeptical of the models that you're running. I use normal distribution with parametric VAR at UTSA for the stock market. It was okay for me to do that because what we had on the stock market paled in comparison to our hurricane and earthquake risk because it was a small number. I have some examples. I'm going to skip through these examples. You can read them on your own. All right, we're running out of time. So next week we're going to have to start stocks and bonds. But I mentioned correlation. This formula, if you are a finance major, you need to know this formula backwards and forwards. It's extremely important. All right. So if you're not a finance major, you don't necessarily have to have it. All right, I'm going to leave this to the Excel application. So if you're not sure on the Excel, I think you're going to find it's pretty easy, and the exam is pretty straightforward. So we are going to have to somewhat skip ahead. But anyway, all right. Extremely important weekend for your projects. So make sure I'm hearing from every team where you are. You need to have a really strong base case in the next 5 or 6 days or so.